Hey everyone, we are still in the short run of a perfectly competitive market structure. There are two restrictions. Number one, the firm has no say on the price. The firm can maximize profit or minimize loss only by adjusting the level of output. Number two, in the short run, the plant size is fixed. The firm can only change the level of output by varying the variable resources, which are raw materials, labor, etc. Now we look at two ways to determine the level of output. Number one, we have the total revenue, total cost approach. The competitive producer will wish to maximize profit by looking at the maximum difference between total revenue and total cost. So I can write here profit is equal to the difference between total revenue and total cost. Break-even point is where the total revenue is equal to total cost so that profit is equal to 0. Now looking at this slide here, the profit is maximized when output is 9 units. Now looking at this graphically, we see the total revenue line is given to us, which is this blue line, and the red line is the total cost line. The maximum profit is when the firm produces 9 units of output. And we have two break-even points here, and these are also called normal profits. This is the point 1 here where total revenue is equal to total cost, or where they're intersecting one another. This is another break-even point where total revenue is equal to total cost. And definitely this part, the total revenue line is above the total cost line, and we have profit. Now let's look at the second approach of profit maximization. That is the MR equal to MC rule. That means the marginal revenue will be equal to the marginal cost of production, and at that point the firm will determine the output level. So looking at the numbers here, we see the marginal revenue is approximately equal to marginal cost when 9 units of output is being produced, and the total economic profit is $299. Thank you very much.